This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's jump to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Jeff's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA posted a build of 1.4 million barrels of crude oil, Cushing, Oklahoma building 701,000 barrels. But those builds on crude were offset by much larger drawdowns on finished products. Gasoline drawing down 4.4 million barrels, distillates drawing down 4.1 million barrels, for a net petroleum products drawdown of 7.2 million barrels. U.S. production ticked down 100,000 barrels to 13.2 million barrels, plateauing, it seems, at 13.3 million barrels. I'm pretty sure 13.3 is still the record high print. There might have been 1 week at 13.4. I can't remember. But this is a second round or third round, if you count pre-pandemic, where we got to 13.3, and that's where things seem to be kind of petering out. So it'll be very interesting to see whether or not it's possible to sustain any growth in U.S. production beyond 13.3 million barrels per day. Moving on to the flat price, it's still out of whack with time spreads, but it looks like maybe the flat price is finally starting to rally to follow time spreads higher. It seems like we keep failing right at $80, right around that psychological round number of $80 on WTI. If we can get above it, stay in the 80s, maybe we'll have a real rally soon enough.
Eric, the one thing I just want to highlight in oil is that it still remains relatively accumulated and bullish. It's above its 50-day moving average, making higher highs and higher lows. But there's been certainly a lack of follow-through on any breakouts. I now am rounding in that 79.50 to 80 area. Any legit breakout into the 80s should spur a $5 advance into the mid-80s. But right now, it really has been over a month of just more of a sideways grind. It'd be really interesting to see if a catalyst emerges to drive that breakout. Now let's move on to equities. I want to get Nick involved in conversation. Nick, what levels are you watching on the S&P?
Spot price right now on SPX is approximately 5,100. The call wall right now resides at 5,200, and the put wall resides at 5,040. The implied move for next Friday's March 15th monthly OPEX is plus minus 90 points. Therefore, the upper implied move is 51.90 and the lower implied move is 50.10. Right now, we have key resistance at all-time highs at 51.50 area and key support at 50.50. So this week we popped to that all-time high level of 51.50 and then promptly sold off down to 50.60 area before popping back up on Powell's commentary, which I believe was a bit hawkish. Right now, what I see is a possible touch of that 5,200 mark area, but I'm bearish in the short term toward that 5,000 level, which if broken could send us down to 4,800 or so.
Yeah, when we're looking at that S&P chart, I just have it on page 4. You can see the upwards channel that I drew on. That's been the primary trend since the start of the year. And this has been primarily driven by just a few handful of stocks. The market breadth remains down around the 60% level, well off of the December levels near 87% as the breadth of the market continues to deteriorate. It's no more evident than by looking at the MAG7 stocks, which I have on page 5. And while everyone's been talking MAG7, we now have a distinct technical breakdowns in Apple and Google and Tesla. And now Microsoft put in a pretty good reversal breakdown in the last few days. And so we have now literally only Amazon, Meta, and NVIDIA holding in. And even then, Amazon's not really contributing to the any of the upwards pressure. Now, this morning, NVIDIA is continuing to gap higher, now up at the 900 level. Increasingly, this is all about a MAG2, which is when will Meta and NVIDIA run out of momentum. And it's in my mind, when NVIDIA does ultimately peak out, and it could be at much higher levels, it could be over 1,000. I'm not in any way saying this is today, the day, but when we see NVIDIA finally peak out, I increasingly believe that that will also mark the swing high of the markets. And so we'll see how long NVIDIA can keep this party going. And when we do reverse, exactly like you were saying there, Nick, is that if we do break this trend line, the 5,000 level will be where roughly the 50-day moving average is, and you'll have approached some different fib retracement zones there. But if we break below the 50-day moving average, which is a moving average that's held since November, then it could mark the beginning of some mean reverting correction, and ultimately that would be of the 400 plus point variety if it was to get underway. And so watching where and how far NVIDIA goes is, I think, a very big key to the theme. Moving on, Nick, what levels are you watching on that Nasdaq 100?
Right now in the Qs, spot price is approximately 437. We have a call wall just above at 439 and a put wall below at 425. The implied move for next Friday's March 15th monthly OPEX is plus minus 10 points. Therefore, the upper implied move is 447 and the lower implied move is 427. Right now, we have key resistance at all-time highs of 440 and key support just below at 430. Now, I'm inclined to think, again, that we perhaps roll over and see a touch low of 420 in the short term. I am bullish on certain names. As you mentioned with the MAG7, I'm actually kind of bullish on Apple on this decline, predominantly because I view them as being a little bit cheap. And I think that they're actually going to be a much larger player in the AI arms race than a lot of people believe, primarily because they have all of our personal information. They've been collecting that for the past 20 years, roughly. I'm also kind of bullish as well on Google because the valuation is kind of cheap as well. So that's my kind of opinion on those two names. But overall, broad market wise, I think we can see, at some point in the next few months of 400 or so after we hit that swing high on the peak of NVIDIA as well.
Nick, I find it a little bit interesting that on the volatility index that even though we've had a couple of days of strength, volatility is definitely approaching still multi-day highs. What's your take here on the VIX?
Yeah, so right now with the VIX at approximately 15, the intraday implied top to bottom range is approximately 1%. We're seeing a lot of put selling on pullbacks and call selling on pops, and I don't foresee that to change in the immediate future. So right now, I'm just kind of neutral, watching and waiting to see if we break above that 5,200 mark, and also if we break down below that 5,000 level, which is a key area. If we do break that 5,000 level, I do see a lot more put buying and insurance buying pick up. That would cause a VIX spike in the short term as well, toward probably around 17 to 20 approximately. Now, moving on to the U.S. dollar index on page 8, I'm curious as to your thoughts here.
The key technical level on the Dixie has been 104, and we were teetering right along it, just barely below it for quite a while there. Just in the last couple of days, we've seen a pretty pronounced breakdown lower, still above 103 as I'm recording, but just barely. And it looks like maybe a move lower is upon us.
Yeah, Eric, we've certainly seen some U.S. dollar weakness just in the last week. Especially, we just saw the yen rally considerably as the U.S. dollar yen broke. And that is certainly spurring some interest as to whether or not this dollar pullback can go deeper. But it really is going to be the ECB today that is going to potentially give a big tell. The euro is trading right at the 109 level, and this kind of 109, 109.5 level in my mind is a level where if the euro fails here and breaks back down, then the U.S. dollar advance is still very much in play. And so my eyes will be on that euro and the reactions after the ECB speaks today.
And moving on to page 9, we have that gold futures chart. Eric, what are your thoughts here?
Well, finally, it seems the long-awaited breakout to new all-time highs above 2100 is upon us. And as so long as it doesn't reverse course and turn into a fake break, this means we've confirmed a positive completion of the long-term cup and handle pattern that began in 2011, greenlighting a new upside target of 2725. But let's not forget that when we're talking about long-term patterns like this, we need to see a move sustained for weeks in order to confirm that that's really happening. So initially, we've got the few days here of action above 2100. The rally looks brisk. It seems to have legs, no signs of a reversal yet. If it holds and continues to hold for the next few weeks, stays above 2100, then it would seem like it's game on for higher numbers. But what brought this on was clearly Waller's comments on Friday. The PCE data on Thursday morning got the rally started, but it was really the interpretation of Waller's comment to mean that some form of QE or reverse operation twist is in the works that really set gold on fire. So the big risk now would be if the Fed walked those comments back and said, oh, no, that's not really what we meant. Now, Jeff Snyder and I already agree that that's not what we heard Waller say, and we thought maybe some kind of comment to walk it back might be coming. But the Fed has had almost a week now to make a statement if they don't like the way the market interpreted Waller's comments, and so far they haven't done that.
Yeah, Eric, this is as legit of a bull breakout as you get in terms of not only did we break to new highs, but it continuously followed through afterwards, and the buying has been relentless. Obviously, there will be dips along the way, but in my mind here, any dips that are like of the $50 variety should attract buy-on-dip traders right away. If we see that pattern, I think 2,300 is a very reasonable upside target for bullion.
Now we have uranium on page 10. And continuing on last week's conversation, Eric, what are your thoughts here?
Well, I said last week that I thought the correction in uranium brought on by thin liquidity trading in the spot market might be ending. We had a massive bounce of over 10% in some uranium mining issues on Friday morning, but it may have been a dead cat. Some issues retraced most of that upside, and Spot, which is intended to track the spot price, even put in a new lower low on Tuesday. But it was only just barely lower, and that lower low didn't beget more selling and accelerate the downside move from there, and it's just barely started to recover, but again, only just barely. At this point, the technicals have turned south on several of the charts, suggesting that we may have just seen a dead cat bounced off the 100-day moving average, and that a test of the 200-day moving average, which is still about 10% lower than the present market on the spot price of uranium, might be in the cards. I sure hope that we'll get that test, because I'd love to add even more to my longs at a more attractive price. So to my thinking, the jury's still out on whether the correction is just finishing up its final bottoming pattern, or if another leg lower is still to come. Some of the charts, like SPUT and URNM, look pretty bearish, but the charts for some of the individual mining shares look like the bottom is probably already in. Only time will tell, but my fingers are crossed for another leg lower so that I can add to my long position. My bullish conviction couldn't be stronger in the medium and long term, so any further short-term weakness will be a welcome opportunity to lever up with more uranium mining shares. Also noteworthy is SPUT, the Sprott Physical Uranium Trust, has traded at discounts to NAV even deeper than 15% in the last week. It's awfully hard not to take advantage of an opportunity to buy physical uranium 15% below already low spot market prices, especially when it's only another 10% or so below that price before the metal itself hits its 200-day moving average, which I'm pretty sure is going to be where the bottom ends up being if we haven't already seen it.
Now, Eric, I did put that discount onto the chart. It's showing here that we're trading over a 15% discount from uranium spot price to where the closed-end fund of the Sprott Physical Uranium Trust is actually trading. It has been at these discounts before, and we have seen that discount actually close and narrow, but it should naturally always trade at a discount, so it'll be really interesting to see whether that gap closes to less than 10% on some sort of a bullish reaction.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.